In this module, we're going to talk in a little bit more detail about what trends are and how you can use them. We're going to talk about some keys to success in trading trends, issues with trading trends. We're going to look at a few different types, introduce you to those concepts. We're going to talk about fractal and counter trends as well and how you can use those. And then we're going to teach you how to identify some trends. And just like we did for the support and resistance, we're going to have you walk away from this course with a couple basic strategies on trading with a trend. So let's get started. All right, guys, I'm going to give you the very important keys to success with trading trends. It's 3 simple steps. 1, determine where a trend begins. 2, plan your trade and enter your position. 3, close your position at your target price. If only it was that easy, right? And it is not that easy. Trends are actually very, very difficult to utilize because you need to have a trend in place. The key to really using a trend successfully is being able to recognize a trend while it develops and before it terminates. So you need to be able to recognize a trend before everyone else recognizes a trend. And you can do that through experience and through education. So let's continue with this. What are some issues with trends and why are they so difficult to utilize when the steps are so simple? Well, first of all, there are no clear rules or requirements for a trend. You can have people who tell you need to have 2 or 3 or 4 or 16 touches on a line of support and resistance before it's considered a trend line. But really, it's that third touch that gives you that profitable entry, because by the time you've got 5, people already recognize it, and that trend and your ability to profit from that trend gets diminished. There are no clear rules or requirements that everyone can agree on for identifying and using trends. 2, they're highly subjective. It's very rare for 2 analysts from 2 different schools to draw the same trend line. Unless you're having someone that you've mentored or you've traded with for a long time, it's very likely that you're going to pick different places to draw your trend lines. And that is just because technical analysis is very much an art, just like it's very much a science. And that's why experiential knowledge is really key for trading trend lines. You need to have that experience to recognize what a trend looks like before it's formed so that you can utilize it and profit from it. Because of all of these things, trends are not very easily programmed. You can't have an algorithm that's very effective in many cases, or at least my experience, I should say, that's really effective at identifying trend levels. The techniques that you hard code into algorithms or even into pattern recognition tools don't always work because there are no clear rules or requirements. Trends influence trends. There are counter trends. There are trends inside trends. There are trends against historical areas of support and resistance. You really need to take into account all of these different factors when you are trying to plot your own trend lines. It's an incredibly complex, harmonious system that relies on almost unending input to create that perfect trend line. And it is not as easy as your 3 steps, drawing a trend line and making a profitable trade. So now you've heard the sermon on why trend lines can be so difficult to use. Let's talk about some basic trends, and then we'll get into fractals and counter trends and some cool stuff like that. So the basic trends start with a basic uptrend. And the way to recognize that guy is you have a series of higher highs and higher lows. And those are 2 buzzwords you're going to hear a lot in TheChartGuys in our communities. And really what it is where you get a high. So here where my cursor is, we have a nice red bar. Here's our high. And then we get a higher high over here. So this high is higher than that one. Like a stair step, you continually go higher. And that works for our highs just like it does for our lows. So here's our low, we got a higher low, another higher low. And those are the basic components of a uptrend. It's a series of higher highs and higher lows. And you can draw in roughly parallel lines connecting the highs and the lows. And the more parallel it is, the more likely it is a trend or a channel. And for a trend to be an uptrend, it requires a direction and a slope. The steeper the slope, the more unsustainable the trend. So you want a nice gradual uptrend with lots of tests of support and resistance and 2 clearly, nicely defined lines of support and resist. And now a downtrend is the complete opposite of that. In this case, we've got a series of lower highs and lower lows. So our high continually drops down, getting a lower and lower price, just like our lows do. And we can still draw in a parallel line that roughly encompasses all of the trading action. And again, because it's a trend, it requires a direction and a slope. And again, I want to reiterate, the more aggressive a slope, the less sustainable it becomes. Lastly, we've got ourselves a sideways channel. And if you remember our support and resistance lesson, we had a $9.35, $9.33 channel was our range. That was indeed a short-term sideways channel locked between two areas of resistance. So a sideways channel is a trend, but it does not require direction or a slope. We still have parallel lines, and we're range-bound between support and resistance. This is an area of consolidation. So if you have a big move in either direction and the RSI needs to cool off and allow the prices to come to a more of a homeostasis, you need to have consolidation. And consolidation is that resting period where prices tend to move slowly sideways and the RSI in the entire market comes to terms with where the price is now. It's important to note that any MA strategies that you want to utilize in a sideways channel won't work. Moving averages require a trend, and a sideways channel, although it is a trend, does not work well for moving averages. So remember that as you move forward with your education. Now let's take a look in a little bit more detail about what we're talking about with fractal trends. So our first example here, we've got a nice hourly uptrend. This is 1 week's worth of data. Each bar represents 1 hour, and we can see that we are in a nice hourly uptrend, setting these higher highs and higher lows. We could probably draw in a couple of elegant trend lines here that would really solidify this pattern. But what we need to know is we got ourselves an hourly uptrend. Things are looking good. When we look at this single bar here, so indicated by the arrow, we've got a nice green bar. And down here, we see another example of a chart. What's interesting, and this is where the fractal nature of patterns comes in, this 2-minute chart fits entirely inside this hourly candlestick. However, when we look at them without any frame of reference for time, all we know is that these are both uptrends. We're setting higher highs and higher lows, and this smaller trend nests inside the weekly trend. All trends look the same regardless of time frame, and the same rules can be applied to them regardless of the time frame that they're on. If you're looking at a weekly, an hourly, 5, 15 minute, 2-minute, it doesn't matter. Trends are fractal. They all look the same regardless of what scale or resolution you're looking at. You apply the same logic, rules, and strategies against them. All right, guys, we've talked about different types of trends. We've talked about fractals. How do we actually identify trends in order to use them? Well, there are a few different ways. We're going to talk about a couple of those now. I'm going to start with moving averages. And moving averages are really just a calculation of the average price of the last X amount of periods. So if you have a 7-day moving average, it's calculating the average price over the last 7 days. A 20-period moving average, the last 20 periods, the last 200 periods would create a 200-period moving average. Now you can use two different lines with different speeds, meaning one could be a 20-day moving average, one could be a 200-day moving average. And that is what we've done in this example here. Our light blue line is a 20-period moving average, so it's using the last 20 prices on every update. So every day it gets a new price, creates a 20-day moving average calculation, and then plots that price point right on the blue graph. Just like the 20-day moving average is doing, the 200 is also plotting the most recent 200 points of data on the graph. It also updates every day. However, you can see that it is considerably less responsive than the light blue line. Every time we get an upswing, we can see our light blue line responding, and really our 200-day doesn't do anything until we reach a point where we have been trending upwards for quite a while. That's because this trend uses the last 200, so a lot more data in order to change its calculation. Only after the price has been moving up for 200 days is this moving average going to see any sort of upside movement. Now what's cool is you can use the crosses of these different indicators at different speeds to identify trends. In this example, we've got our 20-day moving average crossing the 200-day moving average, which indicates for the last 20 periods, we have been moving aggressively to the upside, much more so than we have seen recently, or at least in the last 200 periods of data. Now you can use that cross to project forward and keep an eye out for developing trends. In this case, we do get a very nice trend developing. We get a higher highs and our higher lows, and we can draw ourselves in a nice parallel channel there, and it really captures the development of this trend very effectively. We need to also keep in mind, though, that these are lagging indicators. They look historically. So while we have a nice cross here that happens to work out in identifying this particular trend, we fall out of this trend, we see a backtest of our support and a total collapse, and only several days later do we see a cross indicating that the trend is changing. So we need to be aware that these can be good, excellent tools for identifying trends. They are also lagging indicators. They have told us what has already happened in the past, and that's important to remember. Another cool thing about moving averages, they can often act as areas of support and resistance. We can see here our 200-day moving average comes down, becomes an area of resistance before getting back tested. Again, comes back down, acts as support multiple times before being broken, back testing as a resistance, and then having the price collapse. So, moving averages, very, very useful for identifying trends on both short and long-term resolutions, and we can be using the crosses of different speeds to identify trend changes and project trends into the future so that we can utilize them for trading. Another tool that you can use is the regression line. This one's not as common, but what it does is it allows you to take a block of data, run a calculation on it through the regression line tool, and it gives you an extreme upper and lower range that should contain the vast majority of your price action. If you get a nice channel like this and the line of best fit takes all of your data and fits it nicely into this envelope, it really indicates that you are indeed in a trend, and it gives you a couple of limitations, both upper and lower, that you can use to try to determine when you're going to have a trend change. So the majority of the price action is going to be inside this envelope, and when you move beyond it, it often indicates that you're going to be facing breakout or breakdown conditions. In this example, we can see almost all of our trading actions inside this nice sideways channel represented by our regression line, but when we break that support, the price simply collapses. So regression lines, not as common as our moving average indicators or our trend lines that we're going to discuss next, but it can be a useful tool for easily visualizing when you're in trend conditions.